Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'm going to be reporting flows, and that's estimated net flows into the conventional fund business for the week ended Wednesday, May 27th, 2020. We saw about $2.4 billion come into the conventional fund business this week. We will talk about ETFs as we go on, but kind of the first round will be about conventional funds. Basically, it's the 13th consecutive week that we've seen net new money come into the group, but this week, as was last week, it's a way different than we've seen in the preceding 11 weeks prior to that. Basically, in the prior weeks, we saw people just putting money into safe haven assets. It was all going into money market funds, and this week, as in last week, we saw a minor outflow out of money market funds. People were actually pushing the markets up, and up. I mean, we saw the Russell 2000 gain about 6.64% this week, and this is a Wednesday time period. And the NASDAQ was even positive, but really people were focusing on out-of-favor issues this week. So it wasn't all about the go-go funds, wasn't all about FANG. This really was about small cap, spreading this out and getting a little bit better flows. And this is really on some good news. We saw that many of the economies, in fact, all 50 states are in some sort of sense of reopening, even if it's only phase 1 or phase 2. We're seeing people, actually we just finished the Memorial Day weekend, and we saw people out enjoying, but still being cautious, wearing masks, staying 6 feet apart, doing that social distancing and the like, but enjoying the greater outdoors and being a little bit more comfortable with going outside and interacting with other people. Also, we saw other countries in a rollback position of their lockdown. So this was really a boon for the market. And then last, we heard that the Fed was out there kind of encouraging, and it was actually one of the president chairs, I think it was St. Louis Fed, basically said that they were really encouraging policymakers to go out and encourage people to go back to work and not focus just on providing more unemployment. And I think that was a boon as well. People wanted to hear about that. Well, let's go ahead now and turn our attentions back to the flows and see how the flows panned out. Let's go ahead and take a look at our macro groups. Our macro groups, basically, you see equity funds lost about $3.3 billion, even though we had a fantastic return week. Taxable bond funds, they basically took in about $4.9 billion. Muni bond funds took in $871 million. And like I said before, money market funds were almost flat, near zero. Really, it was about a minus $41 million. So not a lot to write home about. However, that is news because that's really a big trend change that we've seen, again, that we've been winning for 13, 14 weeks now. Basically, investors are no longer just patting the coffers of money market funds. In fact, they're actually removing it. We'll see. And it was kind of a mixed bag when we get to that group in that section. Well, let's go ahead now and take a look play by play of each of the macro groups that I went over. Let's go first to our equity funds group. If we take a look at equity funds, we see that basically for the fifth consecutive week, they've taken in, they've handed back money. This time to $3.3 billion, fifth consecutive week. But for the second consecutive week, we've seen pretty strong returns. This time to the tune of 2.33%. Now remember, this is for a week, and so 2.33%. I know we're used to seeing these 5 and 10% swings now. It's just ridiculous. But if we annualize that over a week's period of time, over 52 weeks, that's a huge number. So 2.33%. How it broke out, though, if we take a look, domestic equity funds took in about $129,000. That's it. Very, very small, almost a rounding error in this case. But again, it was a positive. It's the second week in 3 that they've seen positive flows in the domestic equity arena. And their return was 2.66%. And they also, for the second consecutive week, saw positive returns. Now we get to the non-domestic group, and this is where we saw all the money fly out. This is a $3.4 billion outflow. It's the 8th consecutive week that we've actually seen net redemptions from this group, and they also had a pretty handsome return, 1.58%. Third consecutive week they've seen plus side performance. Now how it broke out is we saw large cap funds, again, take it on the chin, not so bad though, $338 million, but really the big attractor of investors' money, kind of makes sense with a low interest rate environment, was equity income funds. We saw that took about $646 million. Again, this isn't big numbers, but it is a change of pace. Now, on the downside, we saw on the international group, international equity funds hand back about $2.8 billion, and then we saw the global equity funds lose about $0.6 billion, and actually it turns out to be about $644 million. Well, now, let's go ahead and turn our attention to the ETF side of the arena. And usually we have a little bit of a difference in that. And we did. Again, we saw negative flows for the mutual fund industry. But if we take a look at the current slides, and we're taking a look at this, we see that it was just a small inflow. Second consecutive week we've seen inflows into equity ETFs, this time only to the tune of $385 million. And where we saw the money come in was Invesco QQ, Trust One, even though NASDAQ didn't do all that great and Russell did. And we saw about $1.1 billion come into that group. And then we saw the iShares Core Dividend Growth Fund, again, dividends, kind of where people were focused. $811 million in net new money came into the group. On the bottom side, though, if we look at the bottom of this graph, we see the iShares Russell 2000, little head scratcher here. Remember I told you, 6.64% return. But we saw the iShares Russell 2000 hand back about $1.3 billion, was the big loser. And then we saw that the Consumer Staples Select Sector Spiders Fund ETF actually lose about $396 million. And so the story is somewhat similar. I think both the ETF, the authorized participant investor, and the retail investor really were not all that hog wild about pulling the trigger and getting out there in front of, and this was over the Memorial Day weekend, and they really just needed to see how the soft reopening in many of the states, a little bit more aggressive in some of the states, and globally, how this was going to impact, if you will, the kind of the global economy, global health of investors and the like. And so they were a little bit more hesitant coming out and spending any money. But again, they're putting money to work, and where they're putting money to work is in taxable bond funds. Let's go ahead and take a look at that real quick and take a look at that macro group. So taxable fixed income funds for the seventh consecutive week saw net inflows, this time to the tune of $4.9 billion. It's the third consecutive week that they've had plus side performance, and this time to a whopping tune of 0.91%. And I don't say that tongue-in-cheek at all. You know, almost a 1% return in a week's period of time is absolutely fantastic. At the top of the group, the main attractor of assets was corporate investment grade debt funds, took in about $3.8 billion. But as we've been seeing here recently, is investors are in search of yields. Corporate high yield funds, it took in $2.7 billion. Now, flexible portfolio funds handed it back about $1 billion, and we saw that international global fixed income funds basically handed back about $921 million. So really what we're seeing is some really big numbers. I'm not sure if we kind of caught this in what was that 7 consecutive weeks. Keep in mind, prior to that 7 consecutive weeks, we had a meltdown in fixed income. People were very concerned about corporate ratings. Basically, they thought that there was going to be a big number of defaults, and also they were worried about liquidity. And the Fed did come out and said, listen, we're going to provide corporate liquidity, and they even came out and said we're going to do non-investment grade as well. We're going to go out there and buy that and ensure liquidity in the market, and that certainly has helped the markets overall. Well, let's see how those strategies actually panned out when we take a look at the fixed income side of the world in ETFs. So basically what we saw from the fixed income side is a $7.6 billion, 9th consecutive week they've taken in net new money. And at the top of the group, kind of the same thing, people in search of yield, iShare iBox Dollar High Yield Corporate Bond ETF took in about $2 billion. And then we see the iShares iBox Investment Grade Dollar Corporate ETF taking about $1.5 billion. And on the bottom side, we saw that the Spider Bloomberg Barclay 1 to 3 month T-bill, people aren't going for safety anymore, handed back about $371 million. And then we saw the iShares 20 plus year Treasury Bond ETF lose about $163 million. So really not a big story on the downside, but really when we're taking a look at the retail and I'll call it institutional investors, if we're looking at it as the authorized participants, although they are buying, creating shares for you and me to buy on the exchange. But basically we are seeing people willing to put a little bit more risk on, and particularly in search of yield. Well, bringing yield back into play, let's go ahead and take a look at what happened in the money market arena. The muni bond fund arena. Muni bond funds actually saw a net inflows as well. It's the third consecutive week they've taken in net new money, this time to the tune of $871 million. And for the fourth consecutive week, they've posted plus side returns, 0.65%. So 0.65, again, don't want to sound like a broken record, but that is a handsome return for 1 week. especially for muni bond funds. So obviously people are less concerned, and this has to do with also the Fed. We talked about this a couple weeks back. The Fed coming out and saying, listen, we will also support highly rated municipal debt funds as well. And I, again, think that was a boon. If we take a look at it, basically we saw that general insured municipal debt funds took in the lion's share of money, about $420 million. And then we see short municipal debt funds taking about 251. And on the downside, we saw the intermediate municipal debt funds lose about $91 million. Not a lot there. On the ETF side, municipal bond funds attracted about $221 million. So even authorized participants and other people within that arena were also doing the same thing. Looking for yield, looking for safety, looking for treasury-like, better than treasury-like returns, but basically with no tax involved. So about $221 million. Let's go ahead now and turn our attention, and that's back to what used to be the group that was attracting all the money, and that was money market funds. So we take a look at the slide for money market funds. We see that they actually handed back a little bit of money, about $41 million, second consecutive week they've suffered net outflows. And how it broke out, taxable money market funds basically took in about $797 million. And how that broke out, institutional investors actually patted the coffers of taxable money market funds to the tune of $5.8 billion, while retail investors took money out, probably to put money back to work into fixed income and maybe some equity, and basically withdrew about $5 billion from that group. Tax-exempt money market funds, on the other hand, basically suffered net redemptions of about $837 million, and that certainly makes sense with the flows that we saw going in as almost complete offset for muni bond funds as well. Well, that basically does it for me today. I'm certainly taking a look at what's going on in the markets. We're keeping an eye on all the reports of the COVID-19, whether there's an increase in infection rates, making sure that everybody is trying to at least wear masks, try to stay safe, social distancing, washing their hands, and seeing what type of stress it's putting on the market. But really, one of the bits of news that came out today was that we saw that personal incomes jumped 10.5%. And this is really due, because of April, of the $1,200 payment that we all received for a stimulus. But ironically, we see that in the double digits, it's like 12 or 13%. Don't remember right offhand, so you'd have to look that up to verify. But about a 13% or 14% decline in spending. So I think a lot of people are kind of scratching their head saying, listen, there's money sitting on the sidelines. I know people hate when I say that, money sitting on the sidelines. And there are money sitting on the sidelines for a lot of things. And people certainly aren't spending it. So I think we're going to see, again, you see a 10.5% increase in personal income. We're going to see that back down. Once people start going back to work, start losing that incentive to stay home, that $600 extra. Certainly the Fed is talking about trying to find other incentives to get people back to work and take that $600 away. I don't think anybody wants to take that away from anybody. But again, there is no incentive to go back to work if they keep on going, so they need to work around that. But certainly we're going to keep an eye on how that pans out. How April spending was low. We're hoping May will have turned out to be a little bit better as people are going out doing a little bit more retail shopping. They're going out to their favorite restaurants, at least picking up or doing curbside or even sitting in the parking lot and eating. So we're seeing a lot of that. Well, if I haven't done a deep enough dive, you can go to our site at www.lipperusfundflows.com, or you can join us next week when one of our analysts will talk about the flows of the week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.